Powered by Green Lamb Laminates. हर गुस्ताखी साफ.
Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the day's top stories. RBI intervention fails to prop up the rupee. The Indian currency closes at a record low of 80 to a US dollar. Chief Economic Advisor says the government and RBI have taken measures to check the outflow of dollars and encourage inflow of foreign funds. Dalal Street jumps amid strong global sentiment. Sensex extends gains for a fourth straight day, jumps over 600 points. Nifty reclaims 16,500. Huge relief for Reliance Industries and ONGC. Government slashes windfall tax and excise duties on export of crude, diesel and aviation fuel. Cites the fall in global crude prices for its decision. The Delhi High Court grants relief to restaurants on service charge rule, stays guidelines on restraining levying of service charge, directs restaurants to prominently display the levy of service charge on menu and on premises. Consumer Protection Authority says it will appeal against the ruling. NCLT initiates bankruptcy proceedings against Big Bazaar owner Future Retail. It's a big fall from grace for India's retail pioneer Kishore Biyani. NCLT also rejects the intervention plea by Amazon. Restaurants have been allowed to levy a service charge from you every time you go out to eat with your family. The Delhi High Court today stayed a 2-week-old order by the Central Consumer Protection Authority, which had barred restaurants from charging extra on food bills. Restaurants, as expected, have welcomed the court order.
It is one of the most contested part of a bill in a restaurant. It does not matter if you're satisfied and happy with their service, you have to pay service charge on top of the food bill. This charge, contested for long by consumer rights activists, now has a court order backing it. The Delhi High Court today set aside the Central Consumer Protection Authority order banning the service charge. The authority had cited more than 500 consumer complaints when it issued guidelines on the 4th of July. The guidelines made it clear that the restaurants could not add a service charge to the bill or collect it from the consumer in some other name. The guidelines also stated that no hotel or restaurant could force a consumer to pay the service charge. The authority also allowed consumers to register complaints in the regard with a helpline or a mobile app. Delhi High Court has stayed these guidelines, making it clear that consumer had the option of not going to the restaurant if they did not want to pay the service charge.
The order is notice and stay of the guidelines, para 7 of the guideline. The effect is that the restaurants can continue the practice they were continuing with, namely that they can charge service charge between 5 and 10% is what restaurants have been charging. 2 conditions have been imposed. One, for takeaway orders, service charge cannot be charged. And secondly, that service charge is being charged should be displayed prominently, both in the menu and possibly in any other place that the restaurant considers appropriate.
While the authority argued that the charge constituted an unfair trade practice, the restaurant said they have been allowed since 1970s and supplemented the wages paid to the employees. The restaurants also rejected the contention that the charges were arbitrary, saying they were recognized practice all over the world. The High Court, however, ruled that service charge cannot be levied on takeaway and delivery orders. The order also asked restaurants to prominently display the service charge on menus and other locations. The next hearing on the matter will be on the 25th of November. With Anisha Mathur in New Delhi, Bureau Report, Business Today Television.
Indian equity benchmarks continue to rise for a 4th straight session amid positive global market sentiment. Sensex closed at 55,397, up 630 points, while the Nifty reclaimed the 16,500 mark. Sectorally, the Nifty IT index climbed 3%, followed by the Nifty FMCG. The broader market, however, underperformed the frontline indices today. ONGC, Tech Mahindra, TCS, HCL Tech, Reliance Industries, some of the top gainers, while HDFC Life, M&M, Eicher Motors, Sun Pharma and Kotak Mahindra slipped in trade. Meanwhile, RBI intervention failing to prop up the currency, the Indian rupee closing at a record low of 80 to a US dollar. In a big relief to Reliance Industries and state-owned oil refiner ONGC, the government has reduced taxes on export of fuel, while the windfall tax on domestically produced crude was reduced by 6,250 rupees per tonne, that's to 17,000 rupees. The tax on diesel export has been reduced by 2 rupees a litre to 11 rupees a litre. The windfall tax on aviation fuel has also been cut by 2 rupees to 4 rupees per litre. The government also exempted special additional excise duty on exports from special economic zones. The windfall tax had been imposed on the 1st of July to discourage exports and ensure the domestic demand was met. While the Reliance stock rallied on the news today, as did ONGC, the windfall tax cut also benefits Vedanta's Ken Oil and Gas, which produces around 24% of the total crude in India, and reduced tax outgo will help in profitability for the company. HDFC Life reported 21% rise in net profit for the June quarter, buoyed by top-line growth along with higher renewal ratio that boosted margins. My colleague Sakshi Batra spoke to Vibha Padalkar on those Q1 numbers. Listen in.
Recently, very big developments coming in on the group level as well. The HDFC and HDFC Bank merger coming into way. So how is that going to also, say, perhaps benefit you?
So what will happen post the merger and regulatory approvals coming through is that our largest distributor, which is HDFC Bank, will also become our promoter. And so like they have also articulated, HDFC Bank folks have also articulated that it will become either a subsidiary or nevertheless, regardless of the shareholding structure, it will be the promoter. And so there will be full alignment both as a distributor and as a owner of the company. And we look forward to that. I think, again, going back to the customer, what is important is that how are we solutioning for the needs of HDFC Bank's customers? How are we servicing them? How are we being able to have a one HDFC concept so that we're able to service customers of HDFC Bank a lot better?
Okay, understood that. Now, as we understand, as far as HDFC Life is concerned, we do know that you are one of the leaders in the overall new business and the individual new business segments as well in the private sector. Going forward from here, if you could help us understand what is the outlook on the market share that you could share with our viewers?
The market share is an outcome. What we do is that we look at how we can calibrate top line, bottom line, quality of business, the risk on our balance sheet, and so on. So we have continued to stay amongst the top three, both in individual business and group business. And that is something that we are fairly confident of retaining our position.
Okay. Could you also share with all our viewers the outlook for FY23 as a whole on the growth front, and also help us understand what could be perhaps some challenges to that growth forecast, if you could share?
So we have put out last quarter our scorecard for the last 4 years, and we have doubled almost every metric, if not higher. Again, top line as well as profitability, which roughly translates to a growth of about 18-19%. And I'm reasonably confident of having a repeat performance of what we did over the past 4 years once again. So that's the kind of performance. So anything between 17 to 20% kind of a growth on the individual on APE should definitely be possible.
Okay. And any challenges or risks to the growth factors going forward? What would they be?
There are always some headwinds. For example, what we're facing right now on inflation, especially in the term space, if there's a lot of volatility, that is causing some of the being a dampener on sentiments, that can always have a lagged effect if it lingers around for too long. But barring that, I think the fundamentals of insurance, thanks to the pandemic, are now better understood than they were 2 years ago.
Okay. And since we are in the rising interest rate scenario, any impact of that?
We would see limited impact of that. Yes, we do track and publish our sensitivity to interest rates, but the products also become fairly attractive. And we are seeing that uptick on our annuity business as well as on our deferred annuity business, on our non-par business and so on.
Now, another big scare involving a Go Air aircraft today, the third in the past 2 days. A Go First flight between Delhi and Guwahati was forced to divert to Jaipur after the aircraft's windshield developed cracks mid-air. The flight could not head back to Delhi because of bad weather and had to make an emergency landing in Jaipur. This is the third incident involving Go First flights in the past 2 days. Yesterday, one of its aircraft had developed engine trouble while taking off from Srinagar, while another flight to Leh was diverted to Delhi, also with engine trouble. Maruti Suzuki has finally taken the wraps off its new global flagship SUV, the Grand Vitara. The 5th gen Maruti Suzuki Grand Vitara will go on sale in India first and is expected to be sold in multiple overseas markets. It's been developed jointly with Toyota. The Grand Vitara SUV is based on the Toyota Urban Cruiser Hyryder SUV that made its global debut earlier this month. This car will be going against other mid-size SUVs such as the Kia Seltos, Hyundai Creta, MG Aster and Tara Harrier. Bookings have been underway since the 11th for a token amount of 11,000 rupees. It will be sold through Maruti's premium Nexa dealerships and it will hit the roads towards the end of September.
Well, Maruti Suzuki has launched the Grand Vitara. Remember, prices have not been told. This vehicle would be manufactured by Toyota in the Bangalore facility. Talking about the grills, Maruti Suzuki has kept in mind very clearly about the needs and the wants of a good SUV grill. Talking about the connected DRLs, the DRLs are a signature segment for Maruti Suzuki because remember, Maruti has been moving out from the traditional headlamps that Maruti Suzuki is trying to give. Quickly giving you a look at the interiors of the Grand Vitara. If I can ask my camera person to just come and give you a quick look of the interiors, the impressive and the crafted instrument panel with sweeping elements, a rich black fall leather with champagne gold accents, a fall leather with high luminant silver accents and smart hybrid vehicle is also accompanying. Well, remember, this vehicle is intelligent electric hybrid with a dual power electric motor and internal combustion engine, self-charging strong hybrid electric vehicle with energy regeneration and of course 1.5 litre next generation K series dual jet VVT engine. Now coming on to the prices, well, Maruti Suzuki has not really announced the prices as of now. The vehicle looks to be quite big for a mid-size SUV. Remember, the demand for a mid-size SUV is really growing in the Indian markets.
My colleague Chetan Bhutani spoke exclusively to Hisashi Hitakiyuchi, MD and CEO of Maruti Suzuki on the new launch. He said the upcoming festive season would remain subdued for the company as it's difficult to stock up during the season with a huge backlog of vehicles. Listen into a slice of that conversation.
Sir, tell us about this vehicle and when will it go to market in India and how about the sales network? Will it be through Nexa channel and how are you trying to position this vehicle? Because it's a mid SUV segment, not many competitors in the market for you. So tell us about how are you going to position this vehicle and when does the Indian get to drive this vehicle and eventually buy it out?
So this is the first SUV in the mid SUV space from Maruti Suzuki. And this, mid SUV as well as entry SUV, this market is now reaching more than 40% of the total market. Mid SUV is about half of this SUV space, and this space, SUV space, is keep growing. So we believe that our model, because we are starting almost from the zero in SUV space, so we can only go forward and we can only enjoy the growth of our sales in the mid SUV space. So we are very confident.
Tell us about how the market is evolving in India for Maruti Suzuki. The festival season is coming up and it's a lot of cheer for the Indians, and especially with the auto companies as well. So how are you planning to position this vehicle in, or probably another vehicles in the festive season? So what's your outlook on the festive season now?
This festive season is really a little bit difficult for us because usually we increase our stock level and pile up our stock so that we can prepare for the big sales months in during the festive season. But this year we have no room to pile up our stock. So this festive season will be a little bit tough in terms of supply and also to quickly deliver the cars to our customers. From that perspective, this is a little bit tough season for us.
Reliance Industries will buy one of the teams in South Africa's upcoming T20 League. According to an announcement by the company, the team will be based in Cape Town and will take forward the Mumbai Indians brand. Reliance had recently bought a team in International League T20 in UAE. Meanwhile, the other 5 teams in the South African League have also been bought by IPL owners. Let's take a very quick break. On that note, we come back with Ask Udayan.
आ गई। कैसा रहा दिन?
बहुत अच्छा।
कोई वीडियो गेम कवर करने गई थी ना?
वीडियो गेम नहीं माँ, ई स्पोर्ट्स।
ई स्पोर्ट्स
माँ, ई स्पोर्ट्स इज जस्ट लाइक एनी अदर competitive sport. इसमें ना वो सब फीलिंग्स है जो किसी भी और स्पोर्ट्स में है। इसमें इमोशन है, इसमें एंगर है, इसमें सैडनेस है, इसमें हैप्पीनेस है, इसमें कमराडरी है। ये सिर्फ गेम नहीं, ये ई स्पोर्ट्स का प्रीमियर लीग ESPL है।
Hello and welcome. You're with us here on Ask Udayan, the show where we take all your stock market related queries. Remember, you can also send in your query on the number on your screen and we help you with the right strategy during these uncertain times. Joining us to answer those queries, none other than our global business editor, Udayan Mukherjee. And jumping right into the deep end this Wednesday, Udayan, we're talking about IT. Given all the flurry of results, TCS is first on the radar. And we've got Mr. Ramanathan from Chennai who has a query. Let's listen in.
Good evening. This is Ramanathan from Chennai. Mr. Udayan, I have high regards for your opinion on the program. My question is, I have accumulated shares of TCS at 3,624 per share. Value for almost 6.5 lakhs of rupees. Right now, I find it is at minus 16% of my acquisition price. Please advise whether to hold or book loss, or else probably buy some more, hoping to average out. Thank you.
Well, it rather depends on your holding horizon, sir, because TCS is a very, very good company, as you know, being an investor. But right now, there are some headwinds. The global picture is very, very uncertain, both in the US and in the Eurozone, where a large part of TCS's business comes from. And therefore, one is not very clear what the kind of volume picture, business volume picture we are going to see over the next 4 to 5 quarters. That's problem number one. And B, because of the attrition issues with hiring, they've seen considerable pressure on their EBIT margin. So both from a volume point of view and from an EBIT margin or profitability point of view, there are some headwinds or problem areas for TCS. And that is the reason why the stock has corrected from 4,000 to 3,000. I mean, it's a 25% correction in 6 months, which is very unusual for a company like TCS, and which is why your holding price, I mean, you've seen a 16% erosion from the purchase price yourself. I would say that if you've held out for so long And if you can stomach some more weakness over the next 3 to 4 months or 3 to 6 months, I don't think it makes sense to book a loss in a company like TCS if you're a longer term investor. Does that mean that the bottom is 3,000? I don't know. Maybe the stock can rebound and even go down further if there are a couple of bad quarters going forward, which is fully possible for IT. So I think you should be patient and you will do well not to look at the stock price on a daily basis. But if you can take a little bit more of a loss, I think it's possible that TCS goes down to 27,000-28,000 kind of levels even, which would be a very steep fall from your purchase price. But over a period of time, I think you will recoup your losses and do good as well. So I know it's painful to hold on to a losing company, but over a 2-year period, I think you will still be in the green, and then onwards, you probably will make money in this company.
Okay, the other newsmaker of late, of course, has been Zomato with the recent acquisition. So markets clearly showed their dismay at the Blinkit acquisition, and Zomato has been trying to, of course, reassure investors. But let's hear out this particular query.
Hello, my name is Vinod. I am holding Zomato shares of 2,500 quantity at the price of 83. My query is that should I average it at the current levels or should I sell it for a loss? Please suggest.
I'll be careful with Zomato. I actually think it's a very good franchise in its core business, but I suspect that they are making capital allocation errors right now. I'm not a great fan of their foray into quick commerce through Blinkit. I don't know whether they had to do it because of the history of relationship with the company, but in my book, it probably will, on hindsight, will look like a capital allocation error from the Zomato management. Quick commerce is a space where much bigger fish are present. You've got players like Jio, Tata's, Amazon, Flipkart, all in that game. And I do not think Zomato will make great headway. The more I look at this management, I think they are beginning to panic a little bit. So I don't know whether you should be averaging at this kind of price at 54, 55. And it's a tough one to say that you should be cutting out sitting on such hefty losses in percentage terms. But I really don't see any major bounce in that stock from this current level and it going back to 90, 100 kind of levels anytime soon. I would be very surprised if that were to happen. I think there are valuation issues, there are capital allocation issues from the management, and I think even in the beleaguered digital space, you probably have better options to look at than Zomato. So this is not an active recommendation to sell the company, not at all. But I think you should be careful about averaging from here on and just wait and see how the next few quarters pan out.
Okay, Gaurav Gupta has also written in. He has a query on Astral Poly. Let's listen in.
Hi, this is Gaurav Gupta from New Delhi. I had bought around 500 shares of Astral at an average price of 1910 between April and May, and it has been going down ever since. Sold 200 shares at 1640, booking a considerable loss. What should I do about the balance 300 shares? I can hold them for a medium term, 6 months to 1 year. Thank you.
Well, the stock has had a recent bounce. I think from the lows, it's up about 10-12% already. And from the price at which you booked the loss, it has actually gone up quite a bit. And I think there might be a lesson there in that price movement that you probably sold too early. Yes, there was a loss, notional loss, but I don't know whether it was a prudent thing to have booked that loss, because in my book, Astral is a good management. It's a fairly dynamic management, and while it may only be the 4th largest PVC pipes player, I think it's actually a much better player than some of its larger peers like Supreme Industries or Finolex. Actually, Astral Poly is a much better stock to own compared to Supreme or Prince or Finolex in my book, because they seem like a management which is trying to put together a more holistic household products business. So I think they're getting into things like sealants, adhesives, even maybe paints at a later stage. I like this kind of management thinking. They're also a high growth company. I think even in the next 3 years, they probably will grow at 20-25%. And therefore, they have a superior growth profile compared to their peers. Valuations too have moderated because it was a very expensive company. but it's still not a cheap company, but trading at very high PE multiples. But they have moderated somewhat. But I think the growth takes care of some of that. So I would not panic with Astral Poly at this point in time, particularly if Indian companies were to embark on a capex program, as looks increasingly likely over the next couple of years. Then I think companies like Astral will stand to do well. There is only one question which I'm unclear about, which is whether it's better to own Astral or it's better to own something like a Polycab, which is trying to put together a similar kind of a business profile. So these two managements, I think, are comparable. These two stocks are comparable. So in your shoes, I would consider owning a bit of both these companies and see how things go from here. I mean, if that helps you.
All right, and let's also listen in to Nirupam Kakati, who has a query on L&T Infotech.
Hi Udyan, this is Nirupam Kakati. I have 23 shares of L&T Infotech at the rate of rupees 6,046 per share. Should I buy, sell or hold?
You're sitting on substantial losses, and I sympathize with you because L&T Infotech shareholders have not had very good going over the last few months, especially after the Mindtree merger. The stock has nearly halved, I think, over the last year. And that is very unusual for L&T Infotech because it has been a wealth creator over the years, but somehow seems to have lost its way along with the sector over the last few months. I think one of the concerns is, of course, how this merger with Mindtree is settling down at a difficult time for the sector with many headwinds, and that's something which is worrying many shareholders. And I think the other issues probably are that L&T Infotech has a very large exposure to the BFSI segment, the financial segment, where there are lots of headwinds. I mean, you've seen the recent US numbers from large capital market players, even like JP Morgan and Morgan Stanley, and those don't bode very well because the capital market segment is a large segment for L&T Infotech as well. So there could be some volume issues going forward, though I still expect the company to grow at 15% plus over the next couple of years. And they do have some kind of a client concentration risk because the top 5 clients, top 10 clients account for a very large share of their overall business. So these risks are there, but the valuation issues have got addressed because of the halving of the stock, as I mentioned, and L&T Infotech is no longer the super expensive stock it used to be. And now I think valuations are more or less in line with something like a sector leader like TCS. So I think the time to sell L&T Infotech is gone. I mean, at this price, if you sell, you might regret it later. So I guess you just have to bite your tongue and probably grit your teeth and hold on to that stock for the next few quarters, because it is a pedigreed management, and sooner or later I think the stock and the company will generate the kind of rewards that you've been expecting.
All right, that's all we could pack into this edition of Ask Udayan, but do keep those queries coming and we'll take a select few every week. Udayan, thanks so much for taking those queries today, and I look forward to seeing you again next week.
इस समय पूरी दुनिया में लोग कंफ्यूज्ड हैं।